Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've known him for a long time. He is a very good contact to have in the gold and silver industry. He has over a decade of experience working in the precious metal bullion dealer industry, including with Michael Maloney at goldsilver.com. Currently, he is the content executive at SD Bullion. He manages and does a lot of their excellent short precious metal market weekly update videos. James Anderson, thank you for joining me.
Jason, thanks for having me on your wonderful channel and program.
Now, James, you do an absolutely excellent job each week with the major precious metal stories. Lately, the stuff has just been absolutely crazy. I mean, there's no way sugarcoating this since March. So let's talk about some of the craziness that has happened in the last 3 or so months. It seems to me that the rules changes, there's tons of them, and you could go into more details than me. I did a short video on this, though, but the rules changes, is this like 2011 levels, that what happened to try to knock paper, gold, and silver prices down and cap them at a certain price, or do you think this is worse than the rules changes in 2011?
So it's more complex and not as obvious to the layperson watching. In 2011, what they were up to was pretty obvious. They just kept jacking up margin requirements. And most of the longs on COMEX in 2011 were speculator class longs. They're not banksters. They're not commercial banks. Most of the shorts were commercial banks like JP Morgan. JP Morgan was looking at billions in losses from 2010 into 2011. And, they basically orchestrated these margin requirement hikes, CME Group did. And then they attacked, I think it was right at the end of April going into May. And you could see when the price was floating around $48 in the Globex, right after New York closed, in like the thinnest traded time of day. I was just looking at the chart today. Sometimes I have to go back and look at this stuff because it's been a while. A, and then B, it's just hard to remember how brazen this was. But you see the line just flatlined at 48 roughly, and then just shoot straight down to 42. No one would ever execute a trade like this. And so it's pretty obvious, that people are going in and smashing the market. And that was what happened then. And when you look at the technical charts, by the way, after they smashed downward, they kept doing margin requirement hikes because they would use volatility as the excuse to jack up margin requirement hikes on the CME Group. And so they did that for another year or two. I think it cost at the time in like 2011, up to 25 grand to own a contract, or to manage, to leverage out a 5,000 ounce contract. And now that number is only 10 grand. So it was a lot more difficult to go long in silver. It was a lot more expensive because you had to have a lot more dollars to do it. And then it's just the fact that they never dropped margins down until maybe 2013, 2014, they started doing it. But, that was after all the technical damage had been done on the charts. And I know people don't like, sometimes technical analysis, but, about half the market follows it. And so it's almost a self-fulfilling prophecy sometimes. If you can do enough damage on technical basis on a market or on a financial chart, it basically kind of self-feeds on itself. And so then the shorts, really were kicking butt. And JP Morgan actually, by the way, in case listeners out there didn't know, they didn't have a COMEX warehouse from the time they took over Bear Stearns in 2009, 2008 when they took over that desk. Bear Stearns allegedly went under because they could short a lot of silver on the run up to 21. That helped lead them to a lot of losses, and that probably ended up helping bankrupt them. So JP Morgan took them over for pennies on the dollar, essentially, and took over that silver position, and probably did really well going into the GFC in 2008 in fall, because you had the price of silver run from 21 down to 9, and my hunch is they were making money on those drops. But from 9 to 50, I don't think they made that much money. I think they actually were looking at some serious losses, and they were naked short in the sense that they didn't have enough silver to cover the contracts that they had. So if they were called on, it would have been a real problem. And so what happened is after 2011 and their brush with death, or their brush with billions in losses, JP Morgan got a COMEX warehouse. And since then has accumulated between them and their clients about 160 million ounces of silver in that warehouse. And so I was just looking at that chart today. It's gone kind of sideways the last year and a half or so, but 160 million ounces in silver and bullion sitting in the COMEX warehouse is over 50% of the entire fractional reserve silver in that market. it's basically a bigger physical position than the Hunt brothers ever had. Hunt brothers maybe got to 100 million ounces. It's a bigger physical position than Warren Buffett and Berkshire Hathaway had in the late 1990s. And that's only what we know. I mean, they may have a lot more in London that they've siphoned out of SLB because they're custodian for SLB. And so there's allegations out there. Ted Butler's made allegations and such that they have a way larger position than that. I would expect that they do. I would expect that they probably took a lot of silver siphoned over the years from SLB. I'm not necessarily subscribing to Ted's argument that they have silver eagles or silver maple leafs. I think that's not true. But he's definitely. I respect Ted. I respect a lot of the research he's done, and I think he's right on a lot of the things he said about J.P. Morgan. Obviously, they're now under criminal investigation. Have been so from the U.S. Department of Justice for a couple of years now, and a lot of the commercial banks like Scotiabank are just handing over dossiers and documents to the U.S. Department of Justice. So it's going to be interesting to see, not just the traders that hopefully end up, seeing justice, but maybe the bank itself. Maybe we'll see some actual justice being served, because they're literally throwing the entire precious metal trading desk under the bus in terms of criminality when you look at the lawsuits. So I know there's a long dissertation, Jason, but that's just a little bit of a background as to how we've gotten here, and it's a saga.
Yeah, there's a lot of crazy details. In 2000, I think it was 2011, maybe it was 2009 or 10, but Zero Hedge was reporting that longs for futures contracts for silver were being offered 80% cash premiums to not take delivery. Was that 2011?
It's quite possible. I'm looking at the chart right now as far as the amount of silver that's supposedly sitting in the COMEX, and in 2011, especially toward the the run-up phase, there was a pretty good drain going on there. Looks like there was almost 50 million ounces that got drained out of there in a matter of a year or two. So the amount that they had at the time in the COMEX supposedly was just over 100 million ounces, which is nothing. 100 million ounces in the big scheme of things is absolutely nothing. That's like India alone. When India has real big silver imports, they can import up to 250 million ounces or more of silver in a year. Okay, so 100 million ounces is that's like the solar demand of silver per year. It's not that much. Really, in the end, the bottom line is silver. It goes crazy when the marginal buyer wants it, and the marginal buyer is typically the investor, the one who wants to buy it as a store of value. And 2011, you can bet there were a lot of people out there buying silver, and they were doing so, pretty heavily, not just on the retail side, but on the SLB side, and probably on the long side on the COMEX. So you had all three fronts really running hard, and harder than I think the other side, the short side, thought could actually happen. And so what we saw was a price run from 16 in November, I think, of 2010 up to 50 in April of 2011. So essentially a triple folding in a matter of a handful of months.
And then when silver crashed in 2008, when there was the margin call, the liquidation event, I know Jim Poplava, he's talked about this on his radio show from Financial Sense NewsHour and PFS Group. He ordered a ton of physical silver, and they were supposed to have plenty of silver in the COMEX warehouses, and they didn't have it. So he had to wait. So for him to get the paper spot price, and he wasn't paying any of the massive premiums that people were at that time, the Silver Eagles online on eBay or at their bullion dealer, the premiums were insane at that point. I think it was way over $7 an ounce premiums after the paper price got smashed. And for him to get the spot price, the cheaper spot price for only a ton of silver, which, yes, it sounds like a lot, but they're supposed to have plenty of it, he had to wait over 6 months.
Yeah, 32,000 ounces of silver sounds like a lot. It's not. On a retail side, selling that much silver in one transaction per day is not uncommon, especially when there's a lot of silver buyers coming in. 7-figure silver bullion orders to people's doors happen. Surprises me, but there are a lot of those out there. Guys in Wyoming who just don't care. They're like, bring the silver to my house. I don't care. I got guns. That happens all the time. So the fact that he had difficulty having 32,000 ounces of silver delivered to his door in 1,000-ounce bars, it took, you said, 6 months roughly, and probably a lot of pain. It just goes to show you that this canard, the idea that COMEX is like this physical exchange where it's easy to take delivery. I've never done it myself off the COMEX, but I've heard it's kind of a process, and depending on your counterparty, can become a real process. So, and then also the brands and hallmarks of bars you're going to get, and if you're buying a 1,000-ounce bar, you're not getting it straight up 1,000 ounces. None of those bars are homogenous. What you end up getting is 50-ounce variable. So you'll get a bar that's 1050, or you'll get a bar that's 950 ounces in the fractions. And so keeping track of these things is hard. They have to have databases and know exactly where each bar is. It gets real complex when you're talking about these non-homogeneous 1,000-ounce bars. So none of this surprises me. And on a retail side, what we saw in 2008 is akin to a lot of what we're seeing now. I thought, after seeing that in 2008, that we'd see it again. I just didn't think it would happen under this spiral crisis that we're supposedly have gone through. I thought it would just end up being a bankruptcy phase, but maybe that's coming next.
Well, think about it, James, because travel is shut down. So that makes the supply chain tougher. And then you also have mining shut down.
Oh, yeah.
So you have those two things. And then you have the copper price that crashed too. So the copper miners, and there's a ton of silver byproduct, that's the majority of annual silver supplies from silver byproducts. So if the copper miners, the copper price totally collapsed at one point.
Totally. And the other thing, Jason, to add on to that, which are all correct, all things you just cited, I get why it happened. It's just guessing why it happened was really the hardest part. But the other thing was we had 3 or 4 years running into that where I had never seen a situation in our industry where we had tons of secondary silver and gold being sold back into the industry, because you had people who bought it and thought they made the wrong choice and maybe wanted to go chase other asset classes. So we had a lot of secondary silver coming in, compressing margins, compressing the prices of products across the board, whether they be secondary old products or new products. And so people would come in and they'd buy, 2018, 2017, 2019, they'd come in and look at, I want to get some Silver Eagles. Okay, good. I'll go to the page to buy Silver Eagles. Do you want to buy that year's Silver Eagle, which is a little bit more expensive, or do you want to buy the secondary market Silver Eagles? A lot of people didn't care. They just take the cheaper Silver Eagles. And so a lot of the secondary product that came into the industry really pushed down margins. The mints, therefore, weren't selling as much of the new products. So they basically got atrophied along the way. And you look at the U.S. Mint new sale data, last few years, it was pathetic. It was like a 10 million a year tops, if they were lucky, for Silver Eagles. Back in the heyday in 2015, 14, 13, they were doing clips of 30, 40, 50 million sometimes, close to 50 million. So all this is not surprising in the fact that, the bullion industry is consolidated too. There's just not as many big players as there once were. A lot of these companies went under.
Are you talking about like bullion dealers or refiners?
Both. We had refineries shut down for different blood gold scandals. You had dealers shut down because of different reasons. Some were just flat out frauds. Some were just probably got caught in the wrong direction, trading on betting on prices and stuff, and probably went wrong. And were chasing it for, I think, Tolding, maybe that was the story there. He basically made the wrong bet on some trade and was chasing it for years, and then his company went under after a year or two of being late on delivery. I mean, if you know about this industry back in like 2008 and 9, Tolding basically parked itself right between the APs and the retail market. They basically acted as if they were an AP, selling at AP prices, but they weren't actually buying the Silver Eagles or Gold Eagles from US Mint directly. They would just literally add like basis points on top of the products when they get them from APs, and then turn around and sell them to the retail market. So they were just basically trading on the lowest cost tactic. And that worked for a little bit. I mean, if you remember their website, it was absolutely horrid. You'd call the guy and he literally would answer the phone 24 hours a day. I don't understand like the business model they were running, but for it to run, it ran pretty long. It ran for like 3 or 4 years, and they were a big seller. I think a couple of their best years, they sold 340 million ounces or $1 million worth of bullion, but it all came crashing down. I think the allegation is that the guy got caught trading the wrong way.
So AP, for our listeners, is authorized purchasers, right, from the U.S. Mint?
Correct.
Okay.
There's only so many in the world, and it ranges from big bullion desks, in the United States or in Europe as well. Some banks are APs; they'll buy directly from the U.S. Mint, or typically it's similar to the process like when you're talking about the bond market. The primary dealers in the bond market, pretty similar in that way. The U.S. Mint they're not competent enough to do a retail bullion operation. U.S. Mint's not going to sit there and run, their little website and sell you Silver Eagles at, basis points over the spot price and be able to do it profitably and intelligently. What they end up doing is they use a network of dealers who then sell those large lots that they buy from the U.S. Mint to different dealers, whether they're local brick and mortar dealers or, to dealers like us at SD Bullion, et cetera. So the whole, I don't think everybody understands completely how the industry even operates, from the miners down to the refiners, to the mints, whether they're sovereign or private, to the dealers,
I totally agree with you, James, because what people say is that the miners should just not sell to the COMEX, but the miners make doré bars, which are gold and silver, and they're not refined, and the miners then have to sell the doré bars to the refiners. So
right?
if these entities do not want to sell to the COMEX, the refiners have to be on board then.
Yeah, exactly. And they don't know how, think about how expensive it is to run either a mining operation or a refining operation. The cost of capital and the expense to actually do that on a grand scale is huge. And so it's easier said than done is basically what I'd tell people.
And the margins are not good either. So we've had bullion dealers in the last 5 or 6 years for different reasons, like Northwest Territorial Mint, which was a big one. They had to deal with Pan American Silver. We've had Bullion Direct also go bankrupt. And then you mentioned blood gold. I think this is interesting. I didn't know that much about it until last night. I was just happening to watch Netflix's Dirty documentary series, season 2, episode 4, and they had a really good episode on blood gold, talking about how pretty much all the U.S. gold refiners, which then make the blanks to send to the U.S. Mint, they all buy blood gold from Peru and different parts of South America.
Yeah, it's difficult for refiners in the United States to authenticate and make damn well sure that the ore that they're getting is coming from sources that respect, that respect in terms of local tribes where it's being mined nearby. And typically South America, you're talking about countries like Mexico, Colombia, even in Central America, in Guatemala and Honduras, they're mining. They're mining all the way down to Argentina, right? And Chile. Peru is a huge one. Peru and Mexico, I believe, are the 1-2 in terms of silver production per year. So yeah, in terms of this documentary, this goes back to a scandal that happened in the industry right after the 2011 highs. Elemental, I think, was involved with it. There's a few other players that were involved with it. What was happening seemed like it was an operation where a lot of gold that was getting refined in Colombia and in Peru, in places that maybe they weren't doing it above board. And a lot of times in Colombia, for instance, the people who grow coca leaves and such, who are involved in those mafias, they look around and they say, oh, well, how else are we going to make money? Let's extort the people who do wildcat mining as well and tell them if they don't give us a certain cut of what they mine, we'll kill them. And that's basically what they do all up the chain. And so you're talking about a country where, if you've ever been to these countries, you'd realize you're talking about the Amazon jungle here. It's impossible to be, police that. It's very, very hard. So policing these areas it's very difficult. We're talking about thick jungle canopy. And so what's going on underneath it is usually outside of the jurisdiction of even the federal government, right? And they have difficulty policing it. So a lot of that gold, eventually finds its way into supposed miners who are supposedly clean, et cetera, et cetera. And so there's a whole different way. You basically have to think like a criminal. Like, if I had dirty gold, how would I get it through into a refiner and make it look like it's clean gold? This happens in a lot of different places in the world, not just in Latin America, but Latin America is what this documentary that you just talked about, Jason, was highlighted in. And it's been happening. You have corporations that have been buying this gold and using it in their products, all the way from Apple to Samsung to basically any corporation, to Tiffany's, any corporation that uses gold or silver in their products. They probably have some trace elements of these wildcat mines that are still going on today, in Colombia and in places like that. So I don't think it'll ever be stopped. I think that, it kind of goes hand in glove with the phony drug war that we live in. I think they kind of are part and parcel. And you have a lot of times the LBMA will pretend like, that they're on above reproach, et cetera. Like they're on top of this. And then you see these scandals happen, and literally they had Ohio Precious Metals was involved in one of these scandals. They had Elemental was involved in one of these scandals. Those were all LBMA approved bars for a long time. And even while the scandal was happening, they were still LBMA approved bars. It takes them a long time to figure this stuff out too.
Well, do you think that means that they know they have to get the gold somewhere and they're willing to look the other way because they're worried about a shortage? Then what's happened then in the last 3 months, they've been trying to prevent that for years. And one of the ways was to not care that it was blood gold and where it was coming from.
It's possible. I look, the bottom line is it's very hard to police this because if you've ever been to Latin America, there's just certain parts of Latin America that are beyond control of the federal government. You know, I mean, you have areas where if you're in the wrong spot in Colombia, like it's not under the power of Bogota, it's under the power of the local drug war. You know, the guys who are in charge with with violence. So for me to tell you, you know, they had it on there one way or another. The bottom line is that they act as if they always pose as if they're being transparent and pose as if they're beyond reproach, and it's not true. A lot of times, like for instance, the JP Morgan scandal, when they got busted for recently, a couple of their people, the head of the trading desk, U.S. Department of Justice has gone after criminally, and he's indicted criminally. And he was on the board of the LBMA, and the LBMA had to, you know, literally people had to tweet at the LBMA, hey, are you going to kick this guy off the board yet or what? Like it's like they're just they're not proactive. They are reactive, and then they don't even act as if they're human. They act as if they're beyond reproach. It's ridiculous.
Yeah, and that to add to your point there, that JP Morgan trader or former executive in their bullion desk, his lawyer was a former CFTC investigator.
Yeah, that you know, it's a small world.
Well, it's normal DC corruption. I've been here for 20 years, so it's none of this surprises me anymore. Let me just put it that way.
Yeah, I agree.
We didn't do the full rundown then of the last couple months. So we had the margin changes. We also had, you talked about this before we started recording, they changed what delivery bars they could have, what types of contracts. Is this because there was shortages then, not just with supply chain problems, but there was actual shortages then starting in March?
So in March, obviously the issue was, this is what we were told. The issue was because of COVID, they were having difficulty flying, you know, gold or, you know, to different parts of the world. There was plenty of gold. It just wasn't in the right place type of thing, which as you go down the trail of excuses that they were using and then the rule changes that they were making. I'm cynical typically whenever they talk because of all these different things that have happened in the past. And so you start looking at it with a critical eye. And what happened is for a little while there, you know, in terms of gold, let's see what they were humming along. They were humming along at the COMEX with how much? Supposedly they had about 9 million ounces. And then all of a sudden they made this change to the rules where they brought along this new contract called the 4GC contract, which is basically allowing 400-ounce gold bars to be involved in the system. It used to be, you know, in the system, it was only 100-ounce gold bars that would actually be good deliverable for COMEX. The 400-ounce bars were typically used in London. And anyone who knows anything about the bullion industry and gold market knows that the 400-ounce gold bar is like the old relic of the London gold pool days. Like 400-ounce gold bar is a big gold bar. It's like something that is being phased out. In Asia, they don't want 400-ounce gold bars in their exchanges in Singapore or in Shanghai. They want 1 kilo gold bars. That's like the new standard. So anyway, I digress. The point is that COMEX brought on this rule change that, why are you doing this? No one's asking. No one that trades in your market is asking for the 4GC. And I looked just last week when I was doing that video, the 4GC had like 11 volume trading. I mean, 11 contracts are being traded in that thing, and it's 2 months old, and like there's no demand. The market didn't want that. Obviously, you did this for a different reason, and the different reason was they could blow out the supposed underlying gold that's being held in their COMEX in the COMEX fractional reserve exchange. It went from 9 million ounces, and now they claim that there's over 28 million ounces. So effectively, they tripled the amount of supposed gold that's being held in their exchange. And if you look at the sheets, you know, who's supposedly where this gold is, you know, 2 of the places they're basically the types of companies that when you see, you just don't believe it. Like JP Morgan claims to have all this gold. HSBC claims to have all this gold. And both of them are like the usual suspects. The only place maybe I could sit there and really think is true, maybe it would be Brinks. Brinks, there has been a big explosion in gold that's being held there, but I'm not necessarily sure that JP Morgan or HSBC are allocating gold specifically alone for the COMEX. They may be double counting it in a way that they're basically saying that we have gold here and we have gold over there and making cross bets based on probabilities.
We're recording this interview on Tuesday, June 2nd for our listeners out there who want the date. And the gold price is the paper gold price is at $1,728.70. Silver's above 18 at $18.02. I read this Ronan Manley article from Bullion Star. I think it came out mid-April, and some of the details going back over what happened in February and March are insane. It sounds like there was enormous shortages. HSBC Bank, the custodian of GLD, was having immense problems sourcing gold. And the Bank of England, basically, there's a ton of details. This is a really long article. I'm going to summarize it really quick, and you can fill in the details on this, James. It sounds like the Bank of England had to step in and bail out HSBC Bank, the custodian of GLD, and other futures contracts for 170 tons of physical gold, give or take.
Yeah, that doesn't surprise me because there's just been so much demand in terms of GLD investing in the last months. You know, obviously with this situation in the financial industry in the last 3 or 4 months, the amount of demand, that if you go look at a chart of GLD and you look at how much supposed ounces are flowing into that, because they're supposed to be buying gold as there's investors buying into the ETF. You know, it's like, well, if planes aren't flying and, you know, gold's difficult to get around, how is the GLD keeping up with this? And it's possible that what Ronan covered in great, you know, Ronan is one of the best out there in terms of turning over stones and looking at the different facts that are going on and coming out and displaying, you know, his theory as to what maybe really is going on. Because typically in the gold market, what you're told is not true. You have to actually go and look a little bit harder and do a little bit more investigative research to figure it out. So, you know, hat tip to him, because I did see that. And it doesn't surprise me. I mean, GLD, if anybody knows about GLD, you know, when it came around and what it's pretty much been, it's been a good mechanism, I personally think, to get a lot of capital flowed into a derivative that may not necessarily drive the spot price higher. So it's helped to buy time. If you're looking at this with an eye that this gold bull market, I would argue is a bull market that really started in the year 2000. And though it was a terrible bear market from 2011 to about into 2015, it's still, I think, a secular bull market with just a little bit of a bear in between. This is the biggest one of all time. I think we'll never see one larger than this, at least in our lifetimes or even our children's lifetimes, probably. And it's probably going to go through the end of this decade, or, you know, could last even longer. But in order for it to last that long, you're going to have some derivatives and some stretching and some suppressing of what price discovery mechanisms are involved. And my hunch is that GLD has been a very handy trick up the sleeve of the financial establishment to have. And so it doesn't surprise me that the Bank of England and the HSBC would be in cahoots in terms of helping each other out when times get a little stretched in their agendas.
Well, HSBC Bank has a lot of problems in Hong Kong. Their Hong Kong real estate, their mainland Chinese real estate. HSBC Bank has some, if you believe Kyle Bass, they have some loans outstanding to the Chinese banks and People's Bank of China for forward dollar swaps, and about $500 billion in dollar-denominated loans that might not be paid back. So HSBC Bank has a lot of problems. That's probably why the stock price has not been acting well for months now. But James, there was a big discrepancy between what the spot price of gold versus the front month futures contract. It was what, $70? So yeah. Do you think that indicated that there was a physical shortage then?
So I did different videos on this, and I still am not completely certain as to why, and like the main driver of this. What I think is that people went to the COMEX to try and get physical delivery because they couldn't get it through the London market. The London market is typically bilateral, like where you're trading one party to another. There's really no middleman. And when the desks got frozen over by the viral crisis and they weren't operating or functioning well, I think a lot of traders went over to the COMEX and started trading the front month contracts, and there became a discrepancy between London and the COMEX price. And that, like you mentioned, blew out pretty far, and it's happened multiple times. It wasn't just one episode. It happened once, kind of died off, went down a little bit, got back in line, and then it happened again. Yeah, this discrepancy, I've been told by people, and I'm telling you on LinkedIn, and people reached out to me from London who worked in the London bullion markets, and they told me that it's a COMEX problem, that the COMEX is in trouble. And when you look at the 4GC rule contract change, where there's smoke, there's fire. But I think it's also the London market that's in trouble. I think they're both in real trouble, because when you look at the amount of gold that's supposed to be in London, there's maybe like a 500-ton float now between what's at Bank of England already allocated toward governments that are, that's their gold. And there's only, a couple ETFs that have gold there too. And so the question is, well, how much gold can they can they allocate versus all these people who supposedly own the gold that's sitting there. And I think you have two different markets here that are not necessarily trustworthy, and that they require scrutiny at all times. And that's basically what anyone in the gold industry who's spent time and who does any research realizes, is that both these markets are suspect.
Yeah, we're starting to have big discrepancies, I think, in silver now more than gold. The discrepancies with the contracts in silver versus compared to gold. The gold one's gone down a little bit, but we didn't talk about the losses that some of these bullion banks are having. So Reuters reported early April that HSBC Bank, going back to March, had a $200 million in a single day trading loss. These banks are bleeding, hemorrhaging losses. And then recently the story just came out, you covered it in your latest video, that a lot of these bullion banks are debating either leaving COMEX entirely or drastically reducing their exposure to trading on COMEX.
Right. Yeah. So this goes back, if anyone's been watching the spot prices for gold and silver in March, like 23rd or so, the price in early March 20s, you basically had gold run from 1675 or so spot down to 1470, I think, for a low. So it's a dramatic drop for gold in a short time frame, in a matter of a day or two. And then it snapped back, rally beyond, it went right back beyond 1675 back to 1700 in by early mid-April. And so what happened is, I think a lot of bullion banks and traders in the gold and silver market got caught wrong-footed in that March 23rd low, where volatility was the price was just violently going down and then back up. You have HSBC, I think 200 million. You have Scotiabank reported recently 168 million, and I believe before that they had already declared that they were getting out of for years. They basically been trying to sell their desk, and then they finally were not able to sell their desk, and have just basically declared that they're winding down their position. And slowly but surely it's coming out how much that's going to cost to wind down the position. And it was 168 million last we heard, and I bet before it's all said and done, it's going to be more than that.
Well, that's only per day, right? I think the HSBC Bank losses, Reuters reported that was 200 million per day losses.
That was a 200 million per day intraday, and doesn't necessarily, the way that they described it to make it sound not as bad was that it wasn't realized, but it was 200 million loss on a day. In terms of just intraday, it's not necessarily that they lost 200 million, right away. Maybe they made some back, etc. But look, I think between Scotiabank and HSBC, these are two commercial banks that have been involved with the gold industry for a long time. Scotiabank, Scotia Makata, has been in, they have roots all the way back to the late 1600s in London precious metals trading. And so HSBC has been along, for the gold ride for a long time. And they've both been involved in this market heavily. And if you look, and if you listen to anything like Ted Butler, one thing Ted does say is that he thinks that there's a double crossing going on, that he thinks that JP Morgan is going to end up double crossing a lot of the old partners it used in order to suppress the price of metals. At some point, they're going to start bleeding these other traders on the long side and making money as the prices go up. So nothing would surprise me. If anyone's going to make money on the way up, it would probably be JP Morgan of all these banks. They seem to be the most savvy of all the different desks that trade in this industry. But that's one of his allegations, and he's sticking to it. I just read an article he talked about that's likely what he's been proclaiming that was going to happen, and now he thinks it is indeed happening. And eventually, like in 2008, when we saw silver go to 21, you end up having Bear Stearns go under as a bank, and a lot of the allegations were a lot of the losses that they had were on their silver desk because they were naked short and losing a lot of money as the price rocketed up to set 21. And my guess is in the coming years, if this continues onward and these banks get wrong-footed, you're going to hear a lot bigger losses than what we've heard just in March.
So these articles are reporting that the losses are on these exchange for physical contracts. So can you explain in easier to understand terms for the listeners exactly what those are?
Yeah, the exchange for physical is something that I've never rabbit holed down. That's something that Turd Ferguson, Craig Hemke over at TF Metals has spent a long time talking about the exchange for physicals. It's a complex. Whenever I try and understand what he's talking about, my mind starts spinning. But it sounds like for a bunch of years, that was one of the mechanisms that got people who were trading in the COMEX would go to London to get these EFP payouts, and they were making good premium on it, and the bullion banks were fine with it until it blew up in their face. And I think that's what occurred here, is that the EFP didn't work out when you have a discrepancy between the COMEX versus the London price. That discrepancy is effectively what blew all these holes in their profit loss stays. And so, I would ask him specifically, because he's done more work on that matter. I've not, and I would be a damn fool to try and explain what it is when I personally don't even know it down to the fine detail.
So these are not exactly like the gold leases. So the gold leases were how like the price management scheme went on for a long time. So these are even more complex than the gold leasing that bullion banks would do, involving borrowing central bank gold to sell into the market, that the Gold Antitrust Action Committee has been covering for a long time.
Yeah, like I said, that I basically would not profess to be an EFP expert. That's not something I've studied enough to make a solid, verifiable claim. I would ask Craig on that one.
So these sound like leases are also involved, because leases normally help try to stop the shortages. Everyone's trying to lease the metal out to cover their physical losses, and then hope that the mine supply eventually comes back in and they can cover it.
Yeah, if you look at lease rates, they usually explode when there's shortages in the market. So lease rates, for instance, in palladium have been pretty high for years now. They gyrate back and forth, but palladium lease rates usually signify why we had a palladium price, running up to $2,500 an ounce or close to. Lease rates, I think right now on silver are getting snug and getting closer toward positivity, but they're not there yet. I think the lease rates in silver, the highest that ever got was when Warren Buffett went out and bought all this silver in the 90s. If you look at the lease rates happened in 98, they blew out like 60% on an annualized basis, which is absolutely nuts. But that's what happens when you have a big whale come out and take huge amounts of silver off the COMEX. All of a sudden, there wasn't that much silver anywhere else to find. And so industry players needed silver, and they had to go out and they were basically borrowing it from parties that had it, and at a pretty high price.
Yeah, to add to that story there with the Warren Buffett, for our listeners who are not familiar, Warren Buffett did try to corner the market in silver. It was like over 20 years ago, I think. From what I've heard from a couple different sources, that he was actually told to GTFO, get the fuck out of the silver market. And so all that physical silver then was moved into he was accumulating it through brokers, I think on the LBMA, and he was told to get out. And in that physical silver, a lot of it became the SLV.
Yeah, in 2006, all of a sudden the SLV starts with 129 million ounces. I mean, it's like, yeah, it's not a coincidence. Buffett sold it right when the SLV started. So basically where the silver went.
And I don't even know if Buffett made $1 an ounce. I mean, the price barely moved. The silver price didn't start to move until after Buffett sold it.
He did okay. Like if someone's listening to this and cares enough, wants to research it, just Google or YouTube, or just do a search on the internet for Warren Buffett silver horde or silver position, 129 million ounces. You'll find on SD Bullion, I did an article on this. There's a good video of Warren Buffett in the 1997 Berkshire Hathaway meeting talking about why he did this. It's pretty good. Warren Buffett sounds like a complete silver bull. And if you had simply taken out the part where he talks about photography, I mean, pretty much he nails a lot of the points that silver bulls make. He does a really good job of talking about it. But then you also hear him when he's talking about it. He's very, very conscious of not making statements that make it sound like he was going after, basically to control the market or to basically gain complete control of the silver price. He said it. He just wanted to make that bet, and he'd waited 3 decades to make it, et cetera, et cetera. And I think he acquired the position around $5 an ounce, some price like that. And then I think he sold it off 2006 at like 13. So.
Oh, I didn't know he got that much of it. I thought he bought it at 3. He started buying a lot of it at 3, and then he only got it at 4 or 5.
Yeah, he bought it, maybe got some at 4. There's a couple tranches in the photo that I took. You can see I think he bought two main tranches, and you can kind of tell where his price was when it was all said and done. There's a couple pictures in that article that I show. So he more than doubled the bet. But the bottom line is he held on a little longer. He'd have done fine. But the allegations are that one of the other companies that Berkshire owned was in trouble with the financial powers that be in terms of, I think the allegation had to do with some type of fraud, some type of issue that was going on where they were rigging some type of market. and they came to Buffett, and the allegation is that they used that as leverage over Buffett. And the allegation, I suppose, is that they used that leverage to tell him, you got to sell that silver to SLV and do that, and then we'll drop these charges. The allegation.
He also voided the COMEX position limits, right? Because he was accumulating in London.
Yeah, I'm not necessarily sure. There was a recent article on Business Insider about that. I forget the guy's name, billionaire silver investor from the 90s. Mark Kaplan, I believe, is his name. He was talking about how Warren Buffett's taking of that position effectively helped his business and made him into a really wealthy guy. So you probably could learn more about that if you looked at that article. I'm not really sure where he sourced. I think he sourced it in the COMEX because pretty sure, yeah, he did. He sourced it in the COMEX because when you look at the COMEX warehouse, the amount of silver that was in the COMEX warehouse, it jives perfectly with when Warren Buffett went for that position. It precipitously falls down from like, I think in the early 90s, it was a peak at 300 million ounces. And by the time Buffett had taken his position, it was down to 100 million ounces. So my hunch is that that's what the route he took. It was through the COMEX.
Yeah, most people aren't aware of this, but Warren Buffett's dad was actually the Ron Paul of his generation. So Howard Buffett, he was like limited government, he was sound money. And the Republicans and Democrats, like I think the Dwight Eisenhower era, a little bit after World War II, they were making fun of him a lot for it.
Yeah, I mean, Buffett in that article, there's a quote that like, if you looked that quote up, like you would laugh reading it today. He would never say this today, especially not in the situation that we're in. But it's a New York Times article. He said in 2006, it says, and remember back to 2006, we were talking about, housing bubble. People were effectively not thinking in terms of disparity between the haves and the have-nots versus today in the 2020s. I think that's a prevalent issue. So what he said was, there's class warfare, all right, but it's my class, the rich class, that's making war, and we're winning. That's 2006. He said that in the New York Times. It's just Warren Buffett's obviously been successful. He's done really well at compounding, and he understands how to use compounding interest and to, reinvesting dividends from his stocks into buying more stocks and compound that. And as the stock bubble keeps going higher, he does well. And look, that's great. But I have more respect for Howard Buffett. Howard Buffett was, if you read Howard Buffett's work, Howard Buffett was, I think, more concerned about the society at large. And Howard Buffett wouldn't say, I'm part of the rich class and I'm beating the poor class. Like that, to me, that's disgraceful. Like, who would talk like that? I don't think his dad would. And so if you know anything about Howard Buffett, you know that he's a true American and he cared about the society. And I just don't know necessarily if Warren Buffett does. You don't say stuff like that.
Sorry to interrupt you. Warren Buffett didn't grow up rich. I think that's why. So he apparently, his attitude changed a lot over the years, the more money he made.
Yeah, it's a shame because, he puts on a front in front of the cameras and a lot of people still worship him. I don't respect him as much. I don't necessarily, it's great that he made all this, he made this huge fortune. I just don't necessarily think it's deserving of respect, especially when there's statements like that on record of him saying, like, we're waging a war against, there's class warfare, my class, the rich class, and we're winning. If anybody knows anything about high net worth laws in terms of like how you avoid paying taxes, how you can compound all this money outside the system, and then, everyone else, suckers, pay taxes, et cetera, et cetera. That's basically the attitude of the 0.01. And we're at a situation now where, the last time I looked, Credit Suisse 2019 Wealth Report says there's over 80,000 estates in the United States with over 50 million per estate. And so if anybody wants to know who's in charge, that's basically it. Those people. It's not the Democrats or the Republican. That's all phony stuff. Like, the real power are the people who have real money in this country, and they have the rule book set so that they can compound that money. And anyone who doesn't understand history may not understand that this has happened before, and typically it results in a really difficult situation where it's either, typically there's some revolution that happens, or there's some type of war or pandemic. Those are the ways that these types of disparities of wealth end up breaking apart and going back toward the mean, as opposed to extreme levels like they are at the moment. So,
or debt jubilee. Yeah,
debt jubilee as well. I personally think if you're just looking at what the Federal Reserve's doing right now and the way that they're operating, the way that they're talking, this seems like the last shearing before they set this financial system ablaze and all the promises and such they've made. I mean, this bailout, how quickly they came around to doing it during this viral crisis, it just looked like this is totally premeditated and they were ready to go. And it looks like a shearing of Main Street essentially, and the arbitrary chosen insiders get the loans and the funds to go, to basically go get more market share and more ownership. That if they're friends with Steve Mnuchin, or if they're friends with Jerome Powell or the other cronies at those institutions, they'll probably do real well in the coming 5-10 years. But when it's all said and done and they've gotten new ownership and new market share, I think they're gonna burn this currency system down and move on to another one. And FedCoin will probably be involved with that. That's another topic for another day. But I just don't, the way that they're operating, the way that they're talking in terms of infinite QE, and just the way that they're taking the credibility of the currency to the brink, and they're really testing it. I just don't. I think the more the time goes on, the more they're doing this kind of stuff, the younger people are just going to keep, every time they get paid, just keep buying things that are anti-fiat Fed note, in terms of gold, silver, Bitcoin, cryptos, etc. I mean, that just seems to be the theme.
Yeah, and I have my part of my portfolio, big chunk of my portfolio also set up to benefit from this paper price manipulation scheme, where prices are capped at certain levels for a while until the miners run out of economic gold or silver to produce. So it's taken me years to figure this out, but I think the larger royalty and streaming companies just benefit very, very heavily from this. Would you call it a managed retreat, what James Turk is saying? Would you say that that's accurate, or do you disagree?
I think now, yeah, in terms of the trend, the way that this is headed, I think that's what we're seeing. For a long time they were, to go deep into this, probably the deepest document in terms of modern silver price suppression, at least in the United States, to me, is the CME Group's central bank incentive program that's been out since 2013, and it's I think it's still in effect till January 2021, and seemingly every year they extend it. So it wouldn't surprise me come January 2021 that they publish another document on the CFTC's website that says they're extending it out to 2022. But anyone who's ever done the investigative research on what the CME Group's CBIP, CBIP, Central Bank Incentive Program, what that's about, basically it allows foreign central banks to come into COMEX, NYMEX markets, or the Chicago Board of Exchange, and they can trade derivative contracts ranging from interest rates to FX, fiat currencies, to commodity derivatives. And they can use proxy desks, and they can do it they're doing it in high volume. They get CME trading discounts. They get discounts for trading in futures contracts that revolve around gold, silver, platinum, palladium, and interest rates. I think that's one of the most heavily discounted derivatives out there, is the interest rate derivatives. So my hunch is they're in there keeping appearances as if they're sanguine, and to keep the interest rates in line. My hunch is that's what's going on. And a lot of the proxy desks that they're using probably range from the Bank for International Settlements gold trading desk all the way to some of these commercial desks. I'm sure that their clients are JP Morgan. I'm sure a lot of these foreign central banks are working with maybe HSBC or one of these other commercial banks, and doing things in the markets that are not necessarily free market price discovery orientated. They're more so about keeping appearances and keeping things in line, and in terms of no one freaking out and no prices going exponential out of nowhere.
Yeah, it seems there's a real concerted effort with all the different rules changes over the last three or so months, give or take, to try to cap the gold price from getting above 1,800 or 1,900 or 2,000 too quickly. Yeah. You also talked about the WikiLeaks cables from the 1970s, how the paper futures contracts were installed for COMEX.
Right. Yeah. So this was research that I stumbled upon years ago, but I just went on to WikiLeaks because they dumped all these documents, and I'm like, there's got to be some documents about gold, and I started doing research on it, and I stumbled on this one, and it blew my mind. I couldn't believe it, and I shared it on Twitter, and eventually it just caught wind, and basically everybody knows about it now. But it was a document, a cable from the U.S. Treasury. And it was from London, I think, to the U.S. Treasury. So someone was corresponding back toward the U.S. Treasury about a meeting that was happening at the end of 1974. And for anyone who knows about the gold price, history, They know that from the London gold pool failure, the price of $35 an ounce silver or gold in the beginning of 1970 ran up to close to $200 an ounce by the time this meeting was happening at the end of 1974. So you're talking about like 6-time multiple of gold price in a matter of less than 5 years. And the U.S. Fiat Federal Reserve note was under real pressure at that time because everybody knew that Nixon had cut the final ties August 15, 1971 to gold in the Bretton Woods Agreement, those final ties that would make it a full fiat currency. And a lot of confidence was lost and a lot of people were freaking out. And if the gold price goes 6 times 6 multiple, that's kind of scary. And I think the U.S. Treasury was worried because the United States was finally going to re-legalize gold and make private gold ownership re-legal again after they had banned and not allowed U.S. citizens from owning over $100 worth of gold from 1934 through 1974. And I think the U.S. Treasury was concerned because they were about to allow U.S. citizens to own private gold, and they had to figure out a way to scare anyone who's going to think that gold was a better choice to hold over fiat Federal Reserve notes. And so this meeting was in London where the main powers of price discovery were and probably still are in a lot of ways. And the meeting and the correspondence in the Wikipedia cables, you can go read them if you want. But what they say essentially was they should create an outsized derivative contract futures exchange that would have multiples of volume in terms of trading going on versus the physical world. And if they could do that, they could sway the price discovery, and inject price volatility into the gold price, and that would discourage a lot of people from wanting to hold gold because volatility is not necessarily a saver's friend. And lo and behold, 1975, COMEX starts. CFTC, by the way, started at that time. They were supposed to be the regulator. And so anyone who knows about that history knows the CFTC's pretty much a toothless organization. I think they're window dressing. Really, the true power is the U.S. Treasury and the appearances that they want to give off. And they will tell the COMEX and CFTC to do what they deem necessary. So the price in 1975, right when COMEX started, essentially halved. Gold went from just under $200 an ounce almost to about 100. And you had a couple of years of terrible gold price discovery, terrible gold price action for the bulls, is akin to what we saw after 2011. Just a lot more stretched out this time, just because the complexity and the size and scale and the derivatives involved this time. But I think it's pretty much a rhyme with history. We went from then $100 an ounce gold to $800 an ounce on COMEX because I don't think they understood what they were up against in terms of how to control the longs and the people who got really greedy and are fearful from 1977 all the way to January 1980, where the price, I think, peaked at $850 an ounce. And simultaneously, silver was peaking around $50 an ounce. And the Hunt brothers effectively got scapegoated. I mean, basically the CFTC or the CME group just came in, people at the COMEX, it wasn't the CME group then, it was someone else. But the COMEX effectively changed the rules on silver and basically told people you couldn't bet long. So effectively, all you could do was sell. You could sell your long bets, and so the price just fell to the floor from 50 back to 10. So I think people who were trading at gold saw that and knew it was probably over. And a couple of months later, on the other side, the NYMEX, you had palladium and platinum hit new nominal price highs too. So my hunch is a lot of the long bettors probably walked over to those pits and jacked those prices up. And so my thesis has always been, and when this is all said and done, you'll know it's happening because you're going to see platinum, palladium, gold, and silver. They're all four going to be running on an exponential price curve. You'll look at the chart, it'll be exponential. They'll be hitting new nominal price highs in fiat Federal Reserve notes simultaneously. And that, when you start seeing that, you're getting toward the end of this. They're burning the system down effectively, like we talked about earlier. That's effectively what I think is happening. And the complexity that's been involved in this and all the scheming and stuff that's gone on, it's difficult because you got to sit there for a decade plus for your bets to pay off. But if you just look at the facts on the ground and what's happening behind the scenes, et cetera, it all is kind of lining up for this decade for it to be very, very good for people who are patient and who have placed prudent bets in the precious metal sector.
And because of the paper price smashes and the added volatility, it's dangerous to buy all of your position for physical gold or silver at once. And same thing for mining stocks. So I think
Yeah.
smart money now, a lot of professional money managers who are not allowed to allocate to physical gold or silver, I think they're starting to now accumulate the best gold stocks and the best silver stocks are accumulating those on dips. You can see it in the charts over the last couple months that any major dip doesn't last very long, and the dips are bought. There's rallies in the charts.
Another thing to watch too is when, next year or two, when we finally do eclipse the old 2011 high of like 1920, whatever that was, and we clear the psychological level of $2,000 an ounce gold, I think then you're going to start to see the big capital come in, Jason. I think the people who are afraid of buying at this time, they're afraid of seeing, the price fall away from them and getting fired for that bet. I think when you pass $2,000 an ounce gold, I think that the fearful big money managers will finally start dipping their toes too. And so you're going to start to see, I think $2,000 an ounce gold is literally the plateau from which we jump off and really get the mania going, where you start to see, gold gapping up $100 a day, sometimes more, possibly, depending on what's going on in the world, eventually to breach, I did a study on our YouTube channel, one about gold price forecast, silver price forecast, like a long-term forecast using just the M0 hard currency supply out there. And it was only like a month ago I did the work on it. It's just real simple, basic arithmetic. It's just a question of knowing where to find the data, and it's all free. You can all find this stuff for free. It's in the video, and I had a Google Doc and everything that I used in the video. And I think the price for gold was, it's something conservative, like $6,000 an ounce, which that would not surprise me at all, to see that someday down the line. But then I went and looked at the M0 just in the last month. They've moved the M0 up 20%. So now it's $7,200 an ounce. And for anyone who thinks that like this number, this M0 thing I'm talking, this is a precedent that's happened before in U.S. history. In 1934, when they confiscated gold and jacked it up to $35 an ounce, that basically gave you a 40% backing of the dollars that were out in the system. And that's all I was doing a 40% backing. And what would that price be with the M0? And it was a pretty high price. And I think in 1981, that year roughly, we could have gone back on a full-on gold standard. I mean, the amount of gold, the price of gold was so high that the supposed U.S. gold reserves could have fully backed the M1 supply. So that was my bet, is that we're going to end up seeing something similar akin to 34 in 1980. I'm not sure necessarily how it's going to go down, obviously, but I do think that gold is going to go much higher in terms of value.
And hopefully there's not a windfall profits tax for people for gold or silver, because they can't buy and hold and then lock in like what they would with a stock, a 10% long-term capital gains tax, because the government, Daniel Amerman has done excellent articles of this for a decade now. The government has intentionally not allowed people to buy gold or silver and then lock in the lowest possible tax rate.
One good thing is that states are doing a little bit of work in terms of trying to get people to be able to use it without state taxes. But yeah, the federal government still charges, like I think the highest they'll charge on capital gains right now on gold or silver is like 28%. That's not typically what someone pays, though, that's making $100,000 a year and, sells gold or silver at 2x what they bought it. I think it typically falls down to the lower 20% that they have to pay on that for capital gains. But there is that worry that there'll be a windfall tax, et cetera. But, if someone's worried about that, like it's akin to like worrying about gold confiscation, when they called in the gold in the 30s, the research I'd done, it looked like only about a quarter of the citizens followed suit. And like 3/4 of them said, screw you, and didn't bring the gold in. And they literally had to go to one of the Federal Reserve branches. So there's only, how many of those are around the nation? 12, so people literally had to go to one of those banks to drop it off. And it wasn't that many that followed suit. And no one ever got thrown in jail for not complying. All that gold just went into hiding. And you can bet that people are using that gold occasionally on private transactions. And that gold's still around today. And a lot of times people sell them as semi-numismatic granddaddy coins at overpriced prices. I mean, that was what was happening in the run-up from 2000 to 2011. Allegedly, companies like Goldline were, using the confiscation scare tactic as a way to get grandma and grandpa to buy gold at 2x the spot price. And I literally had people calling my desk telling me that they bought gold, back when spot was 600, and that they were still under losses from transactions they made with companies such as that. So this is it's an interesting, long sordid tale, the gold industry, Jason. And sometimes you get an interview and it's like, I could talk for like 10 hours about this. So many sordid things.
Yeah, I've heard a lot of off the record crazy stories about stuff going on in the gold industry and with mining companies and junior miners. We could talk about that a lot longer, but let's wrap up the interview here, James. I want to thank you so much for your time. If my listeners want to check out your excellent weekly precious metal market update summaries, how do they do so?
So we have a blog at our on our SD Bullion website. So just sdbullion.com/blog, and you'll find my latest videos or articles that are posted there. As well, we have a YouTube channel. It's totally free. If you just search on YouTube SD Bullion, you're going to find our channel. And we do once or twice a week. We'll put videos up there that pertain to the precious metals industry. And I'm trying to bring value every one of those videos. So hopefully I continue doing that and people enjoy them.